Investing is an essential element of managing your money and growing your wealth. That seems pretty straightforward, so what's the problem? The truth is, for many, investing is scary. There's so many different ways to invest with so many different risks attached to each. It's challenging to start investing, so let's make it a little easier and more approachable. The following concepts will help you start your journey by showing you where to be cautious, but also help build your confidence. Here are 8 concepts to start your investing journey. Number 1, set goals for yourself. Setting goals is an essential step toward financial success, especially when it comes to investing. Setting clear, attainable goals can help you focus, make a plan, and keep yourself going along the way. You must define your financial objectives and know why you're saving. For example, is it for buying a house, sending a kid to college, or saving for retirement? Knowing your financial goals and how long you plan to invest will help you set your strategy. For example, suppose you have long-term goals such as saving for retirement, which could be decades away. In that case, you may be less motivated to withdraw from your investments before you retire. Your time horizon is the years you plan to wait before you need the money you've invested. This is an essential part of making an investment plan. With a longer investment horizon, you can afford to take more risks with your portfolio and shouldn't be as worried of down markets in the short term. Most investors can use general rules of thumb. Still, everyone has a different amount of risk they're willing to take, and their investments should reflect that. All these things combined add up to goals. Number 2, the more significant the possible gains, the greater the risk. Here's a reality check on risk. Every investment involves some level of risk. If the market goes bad, stocks, bonds, mutual funds, and exchange-traded funds can all lose value. Certificates of deposit from your local bank or credit union are a safer bet, but even they aren't entirely protected from inflation. And though they are safer than stocks or funds, they will most likely not earn enough over time to keep up with the rising cost of living. Greater profits may be attractive, but the chance of losing your money is usually higher. Consider your approach to take risks carefully. You might feel more at ease choosing less risky investments, even if the returns are likely smaller. However, keep in mind that no investment is without danger. There is always the possibility that you will receive less than you put in. Know your risk tolerance and take calculated risks. Number 3, avoid putting all of your eggs in one basket. We've all heard the saying, don't put all your eggs in one basket. When you're investing, it's essential to follow this rule. Spreading your money out over various assets and areas means you won't be too dependent on any one type of investment. If one of them doesn't do well, the plan should be that the other investments make up for it. This is known as diversification. People may be afraid to invest because they don't want to lose money. Putting your money in different investments can help reduce some of the risks. Simply put, diversification just means putting your money in various assets like stocks, bonds, cash, and real estate to try and minimize as much risk as possible when attempting to gain the most you can. Assume you decide to keep some of your money in a cash savings account so that it's conveniently accessible. You also work your way up to owning several residential properties. Your retirement savings are split between stocks, bonds, and cash. This is an example of investing in diverse asset classes. It is significant because different economic events may not influence all asset classes similarly. If you don't want to do the diversification yourself, you can invest in a fund that does it for you. When one investment basket underperforms in the market, another may succeed. This provides some protection against losses to your money and investments. Number 4, if anything appears too good to be true, it probably is. Most of the time, a buyer's decision is basically inspired by what his friends, neighbors, or family do. So if everyone seems to be buying a specific stock, it's natural for new investors to follow the same. However, in the long run, this technique can be doomed to fail. It should go without saying that you should never follow the crowd. Obviously, you don't want to lose your hard-earned money in the stock market. Warren Buffett, the world's most prominent investor, was undoubtedly correct when he remarked, "Be fearful when others are greedy, and greedy when others are fearful." Be wary of high-risk investments that seem too good to be true, and don't invest just because everyone else is doing it. For example, many investors flocked to the digital currency Bitcoin in the latter part of 2017. It was the fresh, new technology that everyone wanted a piece of, and its price skyrocketed. But since then, it's been a wild, bumpy ride. In 2022 alone, Bitcoin lost over 60% of its value. If you were not prepared for your investment to lose half of its value, or you were looking to retire on some of that investment, then this would have been detrimental to you. Number 5, Never invest in anything you don't understand fully. Whatever you decide to invest in, you must first understand how it works. To acquire a stock, you need to know the company's financial direction. When purchasing a mutual fund, you should know its financial background. Even items like annuities should be understood before you proceed to invest in one. Before you put your money into any investment, you should take the time to learn as much as you can about it, so that you know what to expect and what the risks are. Insurance investments, for example, give out a key information document, a KID, and this explains the investment's main features and fees. It is highly recommended that you read this before investing. If you're investing in individual businesses, be sure you understand what they do and how they aim to create money in the future. Number 6, reinvesting earnings can help increase overall returns. Suppose you don't need the income from your investments. In that case, you might consider reinvesting it to buy more of your investment, which could grow in value and increase your overall returns. In simple terms, compounding is when your returns earn more returns. Compound interest is straightforward. When you invest your money, you get interest on it. The following year, you earn interest on both your initial capital and the interest gained the previous year. In the third year, you earn interest on your capital as well as interest from the previous 2 years, and so on. Einstein even said compound interest was the 8th wonder of the world, to show its power. So if you don't need the money right now, let it continue to work and grow for you by reinvesting. If you're new to investing, starting with these investing concepts will give you good initial traction. Remember that investing only seems scary if you're not knowledgeable, so continue to read, listen, and learn about the process. Understand that there will always be a degree of risk, but once you understand your own risk tolerance, you'll be able to use these simple investment strategies so you can put your money to work and plan for your future. If you learned something new today, like this video and share it with your friends. Make sure you subscribe to our channel and click on that bell icon to keep getting notified of more money-related content. See you in the next one.